Hello and welcome to the latest in our Insider Interview video series. Today I'm joined by Job Curtis, who is the fund manager of the City of London Investment Trust. Job, thanks for coming in today.
It's a pleasure.
In response to the volatile market backdrop, dividend investing is becoming fashionable once again. I was wondering if you could explain why that's happening, and also could you name a couple of stocks that you own that are among the highest yielders in the trust?
Yes, well, actually, over the very long run, dividends play a very important part of the total return. People forget about it. People get much more, obsessed with how much shares go up. But actually, in terms of the total return, given a period when shares go down, that the actual dividend pays a very important part. I think people have noticed it more this year because it's been a different type of market. It hasn't been led by the ultra growth stocks. It's actually been quite volatile. Parts of the market have gone down. So at least with the dividend, you get a proper return. You get some cash coming into your bank account. So I think people do appreciate the dividend more. I mean, there is, despite the better performance of sort of dividend paying end of the market, there are still sort of great opportunities out there. I mean, just looking at City London's portfolio, two that come to mind immediately is our biggest holding, which is British American Tobacco, a very unfashionable sector for obvious reasons. But BAT has got a dividend yield of over 6%, and it's covered by its cash flow generation, its free cash flow by yield of over 10%. So it's a well-covered dividend. Their biggest market is the US. They're doing very well over there. But the interesting thing is that they're doing well in cigarettes, but they also are growing rapidly their portfolio of less harmful products, and they are now the slight leader in America in vaping. They've overtaken Juul in the United States. So they're definitely planning their business for a future of a less harmful products, which is a good thing to see. Another stock I could mention from the portfolio, which is on a very attractive yield of over 7%, is M&G, which is a mixture of fund management company, but also got a legacy life business, and they've got something called the Pru Fund, which is a kind of with profits diversified fund which invests in a mixture of equities, bonds, alternatives, and which they're the market leader in. It's a big fund, and it's basically a system whereby shareholders of M&G will get 10% of the profits when policyholders eventually cash in their products. So that means there's a lot of long-term cash generation, and I think the dividend is well covered by capital. So it's one I like at the moment. It came out of Prudential, where it was a demerger a couple of years ago.
And what's your outlook for UK dividends for, say, the next 12 to 18 months? I mean, on the one hand, we have the potential of further interest rate rises in order to try and cool down inflation. But then there's also the prospect of a recession occurring if those interest rate rises are perhaps too aggressive. I assume that all those factors are headwinds for dividends.
Yes, we had obviously if you look back, we had a terrible time at the beginning of the pandemic, and that sort of second quarter of 2020 was a huge number of dividend cuts across the UK market and other markets by companies, some of which are forced to cut their dividends, like the banks by the regulators, others where their businesses literally stopped and they were in no position to pay a dividend. There were others where companies might have been over-distributing for a few years, and it was an opportunity, a smokescreen to sort of reduce their dividend payout to a sort of more affordable level. Since that point, we've had a massive recovery in dividends, I'm pleased to say, and dividends are now slightly above pre-pandemic levels across the whole market. And it was led, the biggest sector has been the mining sector, where we have some big global miners listed in London, and they've benefited from booming prices of commodities such as iron ore and copper. I mean, going forward, if anything, some of those prices are abating a bit. So I'm probably looking at less good dividends from the mining sector. But on the other hand, the oil sector, where both BP and Shell cut their dividends during the pandemic, that outlook looks much brighter now with the oil price where it is, looks good for dividends. Interest rates generally are going up is bad for the market. It's bad for economically sensitive stocks. Obviously, the cost of living crisis is affecting, consumer stocks. So certainly, I wouldn't see huge dividend growth in that part of the market. But on the other hand, there are other areas which benefit from rising interest rates. Some banks benefit from, in the short term at least, as long as it doesn't bring the economy into recession, they benefit from rising interest rates. They can price their deposits better, and it's better for their net interest margin. And insurance companies also, to an extent, benefit from rising interest rates. So all in all, it's a complex picture, but I would see low single-digit dividend growth as achievable by the UK markets. I think we will get some dividend growth, and at the time of talking, the dividend yield in the market's around 3.5%. So it's not a bad mixture at the moment, but it's obviously we're not going to get the kind of boom in dividends we've seen over the last 18 months.
And the prospect of a recession, how much of a concern do you think that is?
Well, it is a concern. A lot of companies are to varying degrees economically sensitive, and I think the issue is really inflation. Has turned out to be much higher than people were expecting. It's partly a reaction to the massive monetary stimulation, fiscal stimulation we had during the pandemic, both in the UK and overseas, including United States. And now the central banks, are kind of reacting with raising interest rates, and it's very hard to fine tune. They're determined to sort of get inflation back down to the kind of 2% level, which is what most central banks are, have as targets. And at the moment, it's way above that, and wages are picking up as well. So, it's going to be very difficult for the central banks to kind of raise interest rates enough to tame inflation, but at the same time not tip the economy into recession. So I think it must be a good chance the economy does move into recession as a result. Plenty of companies are cyclical, but it's worth saying there are large parts of the stock market which are less cyclical. And, I'm thinking of, say, utilities, which people have to carry on paying their water, electricity bills. I'm thinking, say, pharmaceutical companies where, healthcare spending a lot of it's funded by the government. So certainly, and there are kind of more resilient sectors like tobacco. There are sectors that, benefit to a degree from rising interest rates we were just discussing, like banks and financial insurers. So I think, I don't think you could put the market in kind of one bucket. It's obviously part of the inflation has been caused by the oil price, and so the oil companies, are well placed as well, short term. So I think, so I wouldn't say it's a kind of negative across the whole market, but it's certainly not helpful for equities generally.
The City of London has a very rich dividend heritage. Is the Trust on track to deliver its 56th consecutive year of dividend increases this year?
Yes, we've actually just announced our fourth interim dividend. It's just been declared, and so we have made our 56th year of dividend increase. We've increased the dividend by 2.5% this year. I've been managing the Trust for 31 years, and in 9 of those, we've actually used revenue reserves to achieve the dividend growth. It's something investment trusts can do. They build up a revenue reserve in the good years, because you can hold back up to 15% of your income and use that reserve in the difficult years to grow your dividend. So I think we've achieved it by a mixture of having a core of quality companies can consistently grow the dividend, but also, in the difficult times, we have been able to draw down on those revenue reserves and then replenish them in the better years for dividends.
And in the last financial year, did you need to dip into the reserves to fund that dividend?
Yes, we haven't announced our results yet. We're 30th of June year end for the year ending 30th June 22. For the year ending 30th June 21, we did dip into reserves. For this year, the board have made a statement to Stock Exchange guiding that we are expecting not to use reserves, and we're expecting to put money back into reserves for this year.
And going forward, how sustainable is the dividend? How strong are those revenue reserves? Well,
I'm sort of, very positive about the companies we have in our portfolio. We're not over dependent on any one sector. We've got a core of, in my opinion, very consistent companies. They're quite global overall, and some of them got very good dividend records, as well as we've got some interesting medium and smaller companies. But the core is large cap, consistent growers, not too heavily indebted. In terms of our revenue reserves per share, they account for around 40% of the annual cost of the dividend. So we have got a buffer zone there, which is good. But in addition, we have something called the distributable capital reserve, which in extremis we could use. We wouldn't expect to use it, but it's an ultimate backstop, and that's basically the distributable. That's basically profits we've made over the years realised, netting off any losses we've made, and that accounts for about 3 times the annual cost of dividends. So we wouldn't want to use that, but it is the ultimate backstop which we could use if necessary.
And I also wanted to ask about investor sentiment towards the UK. It still seems to me to be quite poor overall. even though, as we've referred to, the larger cap companies in the FTSE 100, they've performed really well this year compared to other markets. So why do you think it is that investors are continuing to sort of stay away from the UK, and what needs to happen for that sentiment to improve?
Yes, I mean, I agree with you. The sentiment has been quite poor. I think it's partly because the UK is quite light in the sort of technology growth stocks, which everybody sort of has favoured until recently. They've suffered a bit this year. And I think kind of one of my competitors referred to the FTSE as being a 19th century index. Well, this year because it's full of oil companies, banks, tobacco companies, that type of thing. But this year we've discovered that we still need oil companies. Banks are still good investments, can be good investments, and tobacco's done quite well. So it's performed a lot better this year. But I think sentiment, I agree with you, it has been quite weak. I mean, globally, whatever we in this country felt about Brexit, I think it went down quite badly, with global investors. And I think that didn't help with the referendum back in 2016. But, the UK has this very open system of corporate control. And I think the illustration of how cheap our market is has been a number of takeovers we've had across the market, often from overseas companies or private equity groups. And in City of London's portfolio, last 18 months, we've had Morrison's, the supermarket, which was bid for by private equity interest. Daily Mail was taken private, Daily Mail in general, by its kind of leading shareholder. And then we've also had Brewin Dolphin, which has been bid for by Royal Bank of Canada. So these are all kind of examples which we've seen but there are many more companies being bid for across the UK market. So I think it just illustrates how cheap our market is. I'm a great fan of the UK market. We've got great companies. We've also got very high standards of corporate governance and a good dividend-paying pedigree. So I'm very happy to be in the UK, and it's good to see the UK performing better this year and beginning to get some recognition.
And my final question, which we ask all fund managers that we interview, do you have skin in the game?
Yes, I do. I have a large holding for me in City of London. It's worth slightly over £1 million. So it's certainly, I'm a great believer in it, and I've definitely got skin in the game.
Job, thank you for joining us today.
It's a pleasure.
That's all we have time for today. You can check out the rest of our Insider interview video series on our YouTube channel, where you can like and subscribe. Hopefully see you next time.